On August 19th, Bitcoin broke past $69,000, while Ethereum cleared a technical resistance level at $2,000 that had held for months. This momentum extended to physical commodities. Gold prices climbed simultaneously, reaching their highest level in nearly 3 months. This chart shows the volume of liquidations triggered by that move. This vertical spike represents $1.2 billion in short positions wiped out within 60 minutes, forcing traders to buy back assets at higher prices. The $517 million in single-day inflows into U.S. Bitcoin ETFs confirms that institutional buyers were participating in this rally alongside the derivatives market. There were no technical upgrades or regulatory shifts from the SEC to explain this sudden demand. These assets were reacting to a macroeconomic shockwave that originated outside the crypto industry. The pressure on the financial system is visible in the national debt, which recently crossed the $40 trillion threshold for the first time. This line graph shows how debt is straining the bond market. The 10-year Treasury yield climbed to 4.7%, increasing borrowing costs. When the 30-year yield breached 5%, it signaled the market was struggling to absorb the debt. The Treasury needed a way to lower these yields and provide a release valve for the bond market before financial conditions tightened further. On August 19th, the U.S. Treasury announced it would double its planned buybacks of long-term government debt. The operation increased from $2 billion to $4 billion per buyback session. This flow diagram shows the mechanical result. By buying back its own bonds, the Treasury injects cash directly into the financial system. This government-mandated demand acts as a floor, forcing the market prices of these bonds higher. Because of the inverse relationship in bond mechanics, as the price is pushed up, the yields are mathematically forced down. This intervention successfully pulled the 10-year yield back from those critical levels. While these lower yields successfully stabilized the debt market, the sudden influx of liquidity effectively devalued the U.S. dollar. As the U.S. dollar weakened, institutional investors adjusted their positions to account for easier financial conditions. Capital moved quickly out of fiat cash and into finite, scarce assets as a hedge against currency devaluation. This pivot explains why BlackRock's IBIT saw such heavy demand, capturing $284 million of the day's total ETF inflows. This correlation between a 5,000-year-old metal and a 15-year-old digital asset suggests investors are viewing both as a singular protection against the debt cycle. Analysts call this the debasement trade. It is the strategy of hoarding hard assets to offset the devaluation of fiat currency. The events of August 19th show that the Treasury's efforts to manage the national debt are a leading indicator for hard assets. When the government devalues the dollar to save the bond market, Bitcoin and gold become the primary destinations for that new liquidity.